good morning, good afternoon to everyone, whenever you're dialing in from. Just to double check if my audio is working, I want to ask to the people to type in the chat box, perhaps that the country they're dialing in from, just for me to double check if everyone can hear me correctly. And I see already first responses coming in. So thanks so much. Happy to hear that everything is working. There are a couple of elements I want to mention around today's webinar. Is that we are aiming for an interactive session, as always. That means that we have polls during the webinars. During the webinar, there's also a live Q&A and panel session towards the end of the webinar with the 3 reporting experts joining us today. Please ask your questions already during the webinar, since then we can directly tackle once we arrive at the panel/Q&A session towards the end. And then I will actually move towards the first slide, where we will start with an introduction. I can start from my side quickly. So my name is Robert Smith. I'm the co-founder of Dazzle. Mostly myself or my business partner Anja de Jager are hosting these webinars. We are very excited for this one. Is the last webinar of the year, and it's on a very important topic, which is ESG reporting. Today with me in the session are 3 of our top-tier freelancers from the Dazzle network. But perhaps I will give the floor to them to introduce themselves, and then we can start with Valentina.
Thank you, Rob. Thank you so much for having me here today. My name is Valentina. I'm based in Geneva, and I'm a freelance consultant working on different sides of sustainability, from ESG disclosure, stakeholder engagement, but also risk assessment. Before becoming a freelance consultant, I worked at the World Business Council for Sustainable Development, WBCSD, and I have a background in international relations and statistics. Thank you. Thank you. Jonathan, you can go next.
Thanks, Valentina. Hi, I'm John. I'm based in London, although I do typically work with a lot of European clients, particularly in Ireland. I work with customers in a range of different industries, but with preparation around corporate disclosure. So typically CSRD reporting or TCFD statements. My background's actually in digital transformation. I was a director in Microsoft's sustainability consulting practice prior to my kind of current role. And I used to work with larger organizations, multinationals, who were dealing with lots of different ESG reporting requirements on their strategy and business case for investing in reporting solutions, ESG data platforms. So that's a bit about me, and I will hand over to Velina.
Thanks, John, and hello, everyone. I'm Velina. I'm based in London, and I'll be bringing a little bit of a different perspective because can I just ask, there is someone who's not on mute, and there is a bit of noise.
Downstairs. Most of the downstairs, except for the bay one's done. So it's actually primarily.
Yeah, I think the person is muted now.
Okay, thank you. So yes, I'll be bringing a bit of a different perspective to the webinar because I come from the investor side. I started a long time ago in a previous life as an accountant and credit analyst, and then moved over to sustainability with one of the biggest investor data and analytics platform, MSCI, in the ESG.
I think Velina lost connection. No worries. We can. Are you still here, Velina? Then we can continue.
Yes, but we can move over. That's okay.
Okay, perfect. For sure, there's of course the additional element once you start presenting as well. Yeah, as everyone knows, there are many developments ongoing in the field of reporting. Most of you must know this as well, in terms of frameworks that have been developed in the last years, pressure from a regulatory perspective, and in my role as well from a Dazzle perspective, speaking to many sustainability directors and managers every week. ESG reporting is a hot topic these days. They call it reporting season, and many companies that we are speaking with are also overwhelmed in this landscape. That's one of the reasons we are hosting this webinar today. The freelancers, Valentina, John, and Velina, will present each on their own input and experience when it comes to ESG reporting in a fixed framework, which is the challenge, the solution, and the outcome. I will directly pass the word to Valentina, where we actually can directly dive into the presentation, and then we can take it from there. And then I pass the word to you, Valentina.
Amazing. Thank you, Rob. So this is me again. You can see that there are 4 main skills and projects that I've been working on in the last years. Sustainability strategy and implementation, disclosure, but also risk management and stakeholder engagement. Next slide, please. So before we start, we're going to talk about disclosure today. As Rob mentioned before, it's a topic that is in everyone's mind, but it's also a moving target. So sometimes we think we get it right one year, the next year things change again. So we feel a bit lost every year that goes by. So I want to start with a quick question, understand a bit more your take on disclosure. So if you can type in the poll in one word, what do you think is the purpose of ESG disclosure and reporting? And hopefully we get different answers, because there's no one right answer here. Compliance, it's usually the first one that pops up. It's a compliance exercise, indeed.
You can use indeed the word cloud that is now popping up for Microsoft Teams, or the comment box. So both are fine. Can you see the responses as well, Valentina?
Yes. Can everyone see the pop-up that just came up?
Yes, I see the responses coming in already.
2, transparency, yeah, for sure. Because you disclose obviously on ESG data to your stakeholders. Any more answers?
Yeah, I see regulatory compliance, monitoring, transparency, accountability, value, social responsibility.
Yeah.
I think that sets the tone as well for the rest of the of the presentation, for sure.
I would say that the key takeaway from these answers is that disclosure is not one person's job, it's everyone's job. Next slide, please.
Yeah.
So since it's everyone's job within a company, there's usually a framework that I try to implement when I work with my clients from different sectors. And it's a 3-step framework to make sure that the sustainability report is consistent and doesn't include any misstatement. So the first step would be to start with the ESG materiality assessment. We're going to see in a minute what it means to have a double perspective to the assessment, which is a way to understand basically your business context. And then we're going to move into the identification of impacts, risks, and dependencies, which is the step number 2. And then everything should also feed into the governance and strategic planning, because it's not only collecting data for the sake of having data, it's about integrating data within the strategy of the business. Next slide, please. As I mentioned, right now, we're going to start with the ESG double materiality assessment. What does it mean? So it's double because it's an assessment including 2 perspectives. One, the impact that the companies have on ESG material topics. So it's the inside-outside view. And it should also include the impact that ESG material topics have on the companies. It's the outside-inside view. And you can see on the right how there's different disclosure frameworks that already have the single materiality approach or double. And in my opinion, we're going to move more and more towards this double perspective, with the EU CSRD being at the forefront of this double material assessment, and many other disclosure frameworks building on the EU CSRD. For example, TCFD, which is a framework to disclose on climate-related risks, and TNFD, which is still voluntary. but it's a nice framework to understand the impact and dependencies of a business on nature and biodiversity. Next slide, please. So how can we do this assessment and get it right? It's all about engaging with your stakeholders, and that's the first step. And that's usually what I usually recommend to my clients when we try to do this exercise. The first step will be to understand who your stakeholders are. And there's different ways to do that, because obviously a company might operate globally, so there might be a lot of people involved, a lot of geographical areas, but there's two criteria that I usually try to implement when I sample stakeholders for the clients I work with. One is diversity. So the company has to engage with diverse communities in the sense that it has to engage with the suppliers, the employees, or if it's for example, a pharmaceutical company, there can be hospitals or doctors involved within the stakeholder pool. And the second criteria should be intersectionality. So you need to ensure diversity within each community of stakeholders. If a company has a global scope, for example, it should engage with suppliers from the different geographical areas involved in the supply chains, because you really need to get all perspectives from all suppliers. So it's impossible to engage with all the stakeholders. We know that there's too many people, but you need to sample them in a way that still makes sense. Which takes to step number 2, which is how to prioritize ESG issues. Again, the engagement has to be participatory. This is also something mentioned in the GRI, the Global Reporting Initiative, in Disclosure 2. There's a lot of ways to engage with the stakeholders, understand how to collect voices from vulnerable communities, for example. So you need to really make sure that the questionnaires you send are not biased, because you want to make sure that all the impacts of your company are reflected into the double materiality assessment. And then sometimes, even if you have a really nice participatory approach with your stakeholders, you might not get all the views collected in the assessment. So step number 3, there should be a review process within the company. So for example, through subject matter expert groups or ad hoc committees able to review the list of ESG material issues. For example, if a company has a no waste policy, it's very likely that circular economy should be something material for the business. So this reviewing process at the end is quite important to ensure that the assessment is consistent. Next slide, please. So as I mentioned at the beginning, we don't assess things for the sake of having numbers. We have to integrate the double material assessment into the second step of disclosure, which is understanding risks and dependencies of the company in the business context, and that's step number 2. Next slide, please. So how do we do that? TCFD, for example, has quite extensive guidance on how to identify the risks, but there's another framework that here I recommend to apply when I work with my clients, which is the COSO ERM Enterprise Risk Management Framework. It was issued several years ago, but I think it's quite relevant to understand how to integrate the output of the material assessment into your risk assessment and management processes. So the material assessment is a way to establish the context, which is step 1, and you can see at the box on the left of your screen. So once you understand your context, the list of ESG material issues, there should be subject matters expert groups within the company, again, that should understand what the risks are for each ESG material issue, which can be a long process, but it's a necessary process if you want to really understand the risks a company is exposed to, which have to be also disclosed. And so once you identify risks, the companies can have different methodologies. I work with different risk assessment methodologies to understand a little bit better this risk analysis and what the company should do when facing different ESG risks. There can be methodologies, for example, heat maps, which ranks risks based on severity or likelihood. but there can be also more advanced methodologies based on network analysis to understand the risk diffusion across supply chains, or how to understand the interaction between different clusters of risks and how these risks can trigger each other, because we shouldn't take risks as isolate entities, but more as a system. And so the purpose of this risk analysis is to come up with a sound risk management strategy, because ultimately you want to make your business more resilient. And at the end of the process, you have to communicate these risks to your stakeholders. Next slide, please. So ultimately, once you've done all your assessment of ESG material topics and risks, we move up to the governance and the strategy setting. Next slide. So this is a little governance framework that I worked on when I was working at WBCSD. And it's a publication conducted with the Institute of Internal Audit, and it's the 3 lines model, which is a quite well-established model in governance. And you can see how, again, disclosure is everyone's job. So the idea is that the governing body, or the C-suite, depending obviously on the kind of corporate governance of the company, should be the one that steers the boat. The governing body is responsible for leadership, for transparency, integrity. So they're the ones that establish governance processes that should make ESG disclosure easier. And then the governing body delegates the management for the operational side of things. So to conduct the double material assessment, to assess the risks. So the first line management roles and the second line management roles should together work to ensure that the data goes to the right places, because at the end, you need to make sense of all this data collected at the company level. And lastly, we should not forget about the internal audit teams, because they play a quite fundamental role in implementing internal controls to avoid misstatements. And we have to make sure that the internal audit team liaises quite well with the external assurance teams, because one of the requirements under the EU CSRD is to have limited assurance on any sustainability-related information included within your reports. So this means that the external auditors come in, and they really have to engage with the internal auditors to make sure that the data is collected in a consistent way. Next slide, please. So I'll stop here. This is the 3-step framework that I usually implement with my clients. But John is going to talk more about this integration and data technology on disclosure. Thank you.
Yeah, thanks so much, Valentina. And I think what you mentioned with regards to stakeholder engagement and especially this final slide, ESG disclosure isn't everyone's job, is one of the more key elements around setting up this successful reporting system in an organization. One thing I wanted to mention towards the participants as well today is I saw already a question coming in from Emmy, so thanks so much for your engagement. If you have any questions based on what Valentina just presented, and also in the with regards to the case of John in the coming slides and Velina afterwards, please already ask your questions in the chat box. Then we can answer them towards the end in the live panel and Q&A session. But then, John, I give the word to you.
Thanks, Robert. And thanks, Valentina, for sort of introducing the topic of CSRD and going down into a bit more detail in particular around double materiality. I'm also going to explore CSRD really because that is where the bulk of the work and demand from clients, I'm seeing anyway, sits. It's what was driving a lot of the investment decisions in sustainability technology. At my time at Microsoft, when I was working with clients, it was, we all of a sudden there's a business case for investing in ESG data platforms, where before a lot of this was done through spreadsheets, people, obviously more progressive businesses adopting voluntary standards, but now there's a lot more scrutiny around the reporting, and obviously this mandatory reporting requirement for EU businesses or businesses with significant operations in the EU. So I will go into CSRD in a bit more detail, but hopefully not repeat too much of what Valentina's covered. So if you could go to the next slide, please, Robert. So on the face of it, CSRD, mandatory sustainability reporting requirement for EU business, is about improving transparency. And I think that came up in the polling, and that's no surprise. I would argue that the real policy objective of CSRD is about driving businesses towards more sustainable business models. It's about the transformation that it will, necessitate for business. The actual reporting piece is the sort of final step. It's all the work that you need to do as a business internally and across your value chain before you can actually start to provide, meaningful, comparable data and information. So if you go to the next slide, Robert, that'd be great. So given its infancy and expansiveness, there are 10 topical standards just in the sector agnostic set of European reporting standards. There's a lot still to be learned, and I think there's a lot of ambiguity still that needs to be tested, and we'll see that when the first round of CSRD aligned reports come out. But there are significant challenges for businesses. So Valentina's obviously done a great job of articulating the double materiality requirements. I won't go into that in any more detail. And likewise, stakeholder consideration here. I think there's a need for new skills within businesses to obviously manage all of these stakeholders across your value chain, incorporate their views into disclosure and also subsequent actions that you're taking. I'm working with a client at the moment who, for example, has pretty good due diligence processes, communication channels with its value chain workers, but hasn't really considered affected communities. And because of CSRD, it will now have to consider that set of stakeholders in its reporting. So it will have to look at investments in that space. In terms of the information that the standard demands, it requires information on the relationship between your strategy and your business model with sustainability matters. You need to be able to answer questions like, how does your business model contribute to or trigger impacts, environmental and social impacts? How are you adapting your strategy and business model to reduce those impacts? What are the anticipated financial effects of those impacts, or risks and opportunities for your business? So all of a sudden, you're having to look at this more strategically. This isn't just a CSR activity, and it's not just here's my current performance. It's you have to be more strategic. You need to be thinking ahead. What impacts is this going to have on our business, on the business cash flows over the next 5 years if we don't act? Assurance requirement. So there's an immediate requirement once you publish your report to have limited assurance in place. But this will increase to reasonable assurance by 2030. So are all of your policies and due diligence processes thoroughly documented? Can you provide information on the methodologies that you're using? Can you substantiate any claims that you're making in your reporting? And are you able to demonstrate to auditors the sort of lineage of the data that you're reporting as well? So that's going to be, I guess, a significant stick for a lot of businesses to do this more thoroughly. Everyone talks about vast amounts of data. I'm seeing that is the case for some of our clients if they're working in a high impact sector where they've got a value chain that impacts across all 10 standards. And that will only increase with sector specific standards as well. And I'd also like to point out, it's not just the quantitative metrics I'm talking about, it's the amount of qualitative information that you're going to have to actually be able to manage, and you're going to have policy and procedure documented, but you also need to be able to tag that in the appropriate format when it comes to constructing your narrative around your actual disclosure. Not on this slide, but I think really important is getting leadership team and board buy-in to the program of work that you're going to need to implement to get this right. So for me, it's that initial engagement with almost education for leadership teams and boards to get them familiar with the directive and understanding what the implications are for business. So these are the challenges, and we can kind of go to the next slide. Disclosure is the final step in the process. I think we talked about double materiality. That's really important. That's going to prioritize where you need to concentrate your efforts and what really matters. And it's obviously a dynamic thing, so you need to do that, you know, on a periodic basis, and also have due diligence processes in place that monitor risk, you know, between reporting cycles. But it's that bit in the middle, you know, you need to ensure that you've got the right strategies and operating model to effectively manage risks, take actions, and maximize opportunities. And that's where I work currently with businesses. So it's that kind of identification of where they've got gaps. I use the standards. The standards are really useful and important for that, so the ESRS standards. But other frameworks and guidance, you know, Valentina alluded to as well, TCFD, TNFD, sector-specific standards, peer benchmarking, best practice within your industry, those are all important things to consider too. And then businesses need to remediate where they've got gaps. And that means sort of develop strategies that they don't have, write policies, strengthen due diligence processes, etc. And obviously source data. And I guess that's where the workforce planning element comes into this. You're going to need new skills, or you're going to need freelancers potentially to come in and implement some of that strategy or develop policies, etc. And you're going to have to invest in systems, so the actual infrastructure to collect and manage all of that information. And only then do you worry about generating the actual disclosure itself. That's the sort of cherry on the cake. If you could move on to the final slide, and then I will quickly pass over to Velina. So in terms of outcomes, sustainability reporting on an equal footing with financial reporting is ultimately where you need to get to. That sustainability information will need to be integrated into your financial statement, or if it's a standalone statement, it'll have to actually have clear references to financial data. So CapEx and OpEx that's been assigned to specific actions, for example, you need to highlight. Because of the assurance requirement, you're going to have properly governed data. You know, Excel spreadsheets may still be appropriate, but ultimately there's a lot of maturity still within the market around ESG reporting software, but that will come in time. There's a digital reporting requirement element to this. It's been slightly delayed because of the EFRAG technical group that's working on the actual extensible business reporting language framework for this. But eventually, everything that you report will need to be tagged against the digital taxonomy, so it can be machine readable. And then comparable. So this is where I'll hand over to Velina, because she'll obviously talk about the users a bit more probably. So investors and NGOs want comparable information about the preparers' ESG performance. So that's really the kind of key output from this. And on that note, I will hand over to Velina.
Yeah.
Thanks, John. I think that was a very nice walkthrough by you and Valentina, and makes my life quite easy coming at the end. I come to give you the investor perspective, and so it's pretty much after John's and Valentina clients have actually managed to sort all of that they have in front of them. And disclose everything what actually happens with it once it gets to the investors, for those of you that might be an investor, or for those of you who might actually have investors and need to deal with them. So next slide, please, and maybe even the next one, Rob, if you don't mind. So what actually happens on the investor side, and what are the challenges? And when we talk about investors, we have to bear in mind we have the asset managers who pretty much sit in between the companies and the ultimate asset owners. So actually, a lot of what happens is at the asset manager level, rather than so much at the asset owner level. Although there is a whole lot happening on the asset owner level as well. And I've spent majority of my time actually working with asset managers. But the few challenges to get through, and hopefully that would give some comfort to corporates as well, that they're not alone in fighting with sustainability disclosures or sustainability overall. their investors are climbing the same mountain, if not even a bigger one. And as we go through that, I probably want you to bear in mind a couple of key points, that sustainability is not, or it's not something that exists on its own, or sustainability reporting exists on its own. It's actually part of a bigger picture, and to tackle that and to get the biggest benefit out of tackling that challenge, you need to have a holistic approach. And I think that doesn't apply just to investors; it actually applies to corporates as well. So looking at the investor side, huge volumes of data. So everything that Valentina and John talked about so far, imagine this multiplied by 14,000. Or even more, because, and obviously not investor would be invested in every company out there, but we have about 15,000 listed companies as an investable universe globally, and some investors are global investors. And on top of that, we have all the private assets if investors are also involved in that asset class. So that is a huge amount of data to just get and process. Multiple use cases, and we are speaking about reporting and disclosure here, but that's not the only use case at the investor level as well. So on the reporting side, some of the data has to be reported at fund level, which is probably the kind of the easiest example is the sustainability funds that need to disclose 30, 40 metrics under the what's called the Article 9 type of funds, and disclosures applicable to those. Some disclosures like TCFD, for example, actually apply at an entity level, so for the entire asset manager. So we already have two different levels to collect and present information. Disclosures are different in different jurisdictions, and even if an asset manager manages a single strategy, if that strategy pulls funds from US, Europe, and Asia, for example, what's applicable in terms of disclosures in Europe is not the same as what's applicable in US or what's applicable in Asia. So for the same strategy, if you pull funds globally, you may need to disclose different things for exactly the same thing that you do. And that's only your disclosure bucket. You may need a slightly different but essentially similar information to use internally for your investment processes, whether that's to build products or whether that's to support your investment teams to actually analyze and take their investment decisions. You may need support and data for compliance teams who need to verify whether everything that is being communicated is a fair reflection of what actually happens in terms of investment decisions and in terms of portfolio holdings, or for compliance to just verify processes. You may need different information to support your teams to communicate and engage with corporates. So already quite a lot of different use cases to balance as well. Changing formats and requirements, and I actually saw a question here about which is kind of the standard for ESG reporting, and fair enough, that's on the corporate side, but I think we would all bet on the wrong horse anyway, because they just change all the time. So the horses that are in the run today doesn't mean they're going to be in the run 5 years from now. So you have to bear that in mind as well, especially on the asset manager side. If you're covering different jurisdictions, Europe is in one place, US is slightly behind, Asia is in a different place as well. So that picture keeps moving. And as you can see from all of that already, you can see how costs can quickly start piling up. Just on the data side, acquiring a simple historical carbon emissions data set might cost you anywhere between 5,000 or 15,000 euros to pounds. And that's only one data set that you may actually need. When we start putting on different use cases and different data sets, you can see how those costs can keep piling up. In terms of team or people management, it's not uncommon on the asset manager side to see teams the size of 10, 15, 20 plus teams, because you would have people, some people dealing only with climate, others dealing only with engagement, others dealing with reporting or disclosure requirements, others dealing with data sourcing, someone to manage all of those people, and that's probably not even the entire picture, because you may have others supporting the investment process or compliance. So it balloons very, very quickly. Next slide, please. So what can we do about that, or what can investors do about that? And there are a few points here, but I'll probably focus on two of them, which is scope and automation, because I think this is where the biggest duplication and the biggest cost are. So it would be beneficial if people can get those right. And it is a bit of a reflection where we are. It is a bit of a reflection of how we got here. On the investor side, the needs or the use of sustainability data evolved over a long period of time, and actually reporting came reasonably late, and it came after all the other more investment related needs. So what usually happens, the solutions are there in terms of IT support and automation. I'll probably say there are too many, and probably for most of the needs that investors have, there is an automated solution that exists. The problem is because that all of that evolved over a long period of time and as separate use cases, what investors usually have is a solution that covers only one of their use cases. And you can see how duplication very quickly occurs, because now you have a few different investment use cases. You have a few different reporting use cases, because you may need to report in Europe and in Asia, and that may not necessarily be the same provider, because the solution in Europe was developed from a different provider than the solution in Asia. And I think this is why it's important to just take the step back and actually go through and start with what are the outcomes that you need to achieve and get your scope right, so that then when you start automating and start making those processes easier for you, you actually don't end up with automating 3 different processes with 3 different solutions, and subsequently realize that they're all pulling data from the same data set, but you're paying 3 times. What usually happens as well, I don't know on the corporate side, but what I've seen on the asset manager side is that data and solutions get procured independently. So an investment team might procure their data or solution independently from their compliance team or from their reporting team. While again, they're all kind of looking at the same data set, but from a slightly different perspective. But if it gets procured separately, it actually adds on to the cost that asset managers have, and that makes things less efficient. And I think keep it flexible. I cannot positively say that there is a solution out there that answers all the questions or delivers everything that an investor needs, and that is flexible enough to survive that change of reporting standards and requirements. But as much as possible, that should be in the mind of people putting solutions in place, so that when things change, the solutions can actually stand the test of time. And maybe the last one that I want to tackle, substance over form, and that's an accounting principle from my distant life when I was an accountant myself. I think because of all that proliferation of data, everyone is just so focused on data at the moment, and it's not uncommon to see not just data, but it's not uncommon to see sustainability reports or TCFD reports in the hundreds of pages. I think, bear in mind, and maybe that's more valid for the corporate audience as well, someone has to read those hundreds of pages, and it might be good to maybe check how many downloads you got on that report, and compare it to the people who applied for a sustainability job with the company over the year, because those are definitely going to read it. But it is way too much data. So as much as we can go for efficiency and what actually matters, it would not only help your life, but it would also help the life of the users of that data. So I think these are kind of my key higher level suggestions. Much easier said than done. It is really very, very complex just to navigate all the different parts of the puzzle and everything that needs to get done. But I think it is worth planning and thinking about it rather than tackling everything head on as best as you can, and duplicate efforts in quite a lot of places. So I think I can just finish off, Robert, with the final slide, summing up on really going back to use a very well-defined criteria, strive for less, which gives you more, and keep the flexibility in mind, because unfortunately we're not going to see the space stop evolving anytime soon.
All right.
That'll be from me.
Thanks so much, Velina. Before we dive into the Q&A session and a panel session, if anyone has any questions, I saw already some questions asked and already answered as well by John in the chat. Please ask them now. But before we dive into it, I perhaps also have a few questions towards the three of you. Listening to the three of you, and also in correlation with the title of today's webinar, is Tackling ESG Reporting from A to Z. Perhaps directly back to you, Velina, to take a whole step back from your point of view. Why is reporting so important actually when it comes to sustainability for organizations?
I mean, in my mind, from the investor perspective, bearing in mind that some investors would be institutional investors, in terms of asset owners, some asset owners would be institutional investors, but the vast majority and the ultimate investors are actually individuals. Individuals do not spend a lot of time checking what is the sustainability footprint of their investments, or even if they do, it's so much data that it's just way beyond the average individual investor to comprehend or make sense of. So the importance from an investor perspective actually, to me, lies more on the corporate side, where the professional investors can actually have access to structured and comparable data. Because as I mentioned, I mean, just the data points out there in terms of what is available, they run into the hundreds per company, and then the number of companies runs into the thousands. It's a vast amount of data to go through, and when that's comparable, when you have comfort that that's been through some assurance procedures before it gets reported, that then makes the use of that data much more reliable. From an investor side. So this is where I'll put it from an investor side.
Yeah, I see it. From my side, it also makes total sense. And then perhaps towards you, John, before we move forward,
Yeah. So why is ESG reporting so important? I'll go back to Velina's point around substance over form, because I do think it's worth pointing out that I think it can be viewed as, it could just become burdensome, and it can be viewed purely as a compliance exercise, or it can be something that ties up all of your sustainability resources for months on end in a sort of never-ending reporting cycle, to the detriment of actually getting on and improving performance. And I think that's where I go back to my point around transformation is really what it's about. It shouldn't just, transparency is really important. I think Manuel, you've mentioned in here, should transformation take place before reporting? Well, transformation should be ongoing, and then reporting should give a sort of snapshot in time or a view of the last reporting period and what improvements you're making. It should demonstrate the transformation that you're making. That's why, and the reporting's there to obviously ensure that businesses do that, and they can't just hide behind a load of CSR kind of fluff and messaging. But yeah, I think it's important because it should drive better behavior and transformation in businesses.
Thanks so much. And then a final one, perhaps towards Valentina, on a bit of a different question, is what do you think the number one challenge companies are facing at the moment when it comes to sustainability reporting? How would you tackle it? I know we have already discussed this framework of challenge, solution, outcome, but perhaps sort of concluding the three different perspectives. Do you see one biggest challenge that organizations are facing now?
Thank you, Rob. Well, first of all, maybe the methodological approach that companies should take when engaging with stakeholders or conducting a double material assessment. There's still a lot of confusion on how to make sense of all this data and how to collect all this data. So to also jump on a question that I just saw in the chat, it's not about engaging with all stakeholders. It's about sampling the stakeholders in a way that reflects the population of stakeholders. So you have to select them in the right way. And I feel like, the main challenge is this, that we have so much data around us. How can we make sense of all this data we collect, and how do we collect it? And I think that technology, but also continuous improvement to integrate these metrics into the business strategy is the solution. Let's not take disclosure as another tick in the box exercise, because that's not the purpose. It's a process to have a better understanding of the company, which ultimately also is the best way to engage with the stakeholders. So that's for me.
As John said, it's not only about transparency, but also transformation then. Perfect. Then we indeed have additional questions in the chat box, but please bear with me. Before we dive into the panel session, I will quickly explain who we are as Dazzle and what we actually do. And then afterwards, we will tackle all the questions and do the live and have the live panel session in the remaining 10 minutes. So quickly presenting Dazzle in sort of a visual, why Dazzle and what is our positioning in the market of sustainability. Dazzle is a sustainability freelancing platform matching organizations with sustainability professionals in the market. This visual summarizes where we stand for and what we do and how we differentiate from other organizations in the industry. Myself coming from a consulting background and speaking to a lot of sustainability managers and directors a week. What we are trying to build with Dazzle is making sustainability expertise financially more accessible for organizations and providing extra hands for executing sustainability strategies for where it's needed. We see with our top tier freelancers in the network 3 main options for collaboration, where we are, for example, speaking to the sustainability manager who says, I don't per se need someone full-time now in the team, but it could help to have sort of a retainer model for the next 3 months where a reporting expert can support me on publishing our GRI annual report. Is more the retainer model, project-based, which is very traditional consulting model with a very clear start and a very clear ending. And we are in conversation also with companies who are more leaning towards this more ad hoc and hourly support, who are, as an example, you're working on a TCFD on the TCFD standards and are perhaps a bit stuck in the process and want a handful of buckets of a specialist who is already in the field of TCFD and reporting for multiple years for advisory. Then there's this final slide around how it works. Is we have developed this 4-step process with Dazzle, where it's discover, scope, offer, match. So this showcases we are not a freelancing marketplace. We're really a matchmaker. So we have the conversation with companies, we understand and scope their needs, and then based on their request, we propose a top-tier freelancer profile that's best capable of supporting them to, as a last step, get to work. Then I think we can actually step into the Q&A session. Before that, I want to launch a very quick poll. If you are hearing Dazzle and you have seen the presentation of today with Valentina, Jonathan, and Velina, and you say, I'm interested in learning more about Dazzle in a one-on-one conversation, we are very happy to, of course, follow up after the webinar to plan this meeting with you. To discuss your case a little bit more in detail and see if we can support you in your sustainability journey. All right, we can move to the Q&A section. I'm looking at Valentina, Jonathan, and Velina. Do you see any questions in the chat box where you would say, I'm already comfortable answering this specific question from your side?
I think there's an interesting point around what standard's becoming the standard in ESG reporting. And I'll try to answer this in a way that's not too partial, because I think Velina made a really good point, which is, at the moment, from an investor perspective, you've just got to deal with loads because there's no kind of global unified standard besides what ISSB is defined, and that in itself is quite limited. So the IFRS standards only cover climate change and haven't yet been adopted by every country and market. So I think CSRD, if you're a corporate entity, is the most expansive at the moment. It's the most sort of exhaustive of the standards. I think if you can satisfy CSRD, and by CSRD, I'm talking about the European Sustainability Reporting Standards. If you can satisfy that, it should be interoperable really with IFRS standards, and it should cover information that you need for EcoVadis kind of reporting, etc., and benchmarking. So that's where I would start. Obviously, if you're not a business that's immediately impacted by CSRD, you could adopt it in a voluntary capacity. And if you're a smaller business, the draft SME version will be published fairly soon, so you could adopt that standard. But that's my thought in terms of there isn't a standard, but that's probably the one that makes most sense at the moment. But things could change in the world of politics. So I'll let Velina and Valentina give their perspective.
Yeah, I totally agree with you. I think the CSRD is the most comprehensive one at the moment. And it's also based on the GRI disclosures, the Global Reporting Initiative, which is already quite well used, understood, and established. And I think last week, the GRI published a mapping between the GRI disclosures and the ESRS, the European Sustainability Reporting Standards, so many acronyms. So it could be an easier job to go from GRI to CSRD. And then, of course, you can complement information with voluntary disclosure requirements like EcoVadis, or you can have your targets validated by SBTi, the Science Based Target Initiative. But I would say start with the mandatory requirement, depending on your business, and then you can add on that. If I can pick another question, there was one on who should check the double materiality assessment and the analysis. It depends on the company. There's different governance structures. It could be the internal audit team reviewing the methodology and the data collection process. But usually it's in the hands of the sustainability teams. They are the ones that set the methodologies. And then on a yearly basis, the consultants arrive and can provide also some input. So it's the stability teams and consultants usually. They're the ones that review the assessment. Anyone wants to add anything else on the topic, materiality assessment?
I think the questions primarily relate to corporate rather than investor side, but maybe just on the standards one. To add from the investor perspective, it is a similar situation on the investor side. The European framework at the moment, SFDR, is the most comprehensive, and usually what we've seen on the investor side, not just for sustainability disclosures, but for anything else in terms of compliance, people tend to pick the most strict one and then comply with that and apply that globally. So I think the message here kind of makes sense in line with practice elsewhere as well.
Yeah.
It might be useful just to sort of elaborate on your question, Gaurav. There's how can a HSE, so how, I'm assuming that's health and safety executive, is that organization or a
health, safety and environment?
Is it how can a system, just to explain the question, it might be useful to just to elaborate on that. Oh, okay, can cover it. So I mean, there are, I would say from a CSRD perspective, interestingly, there's across a number of different standards, information that's required around health and safety. So there's the health and safety, for example, of employees. So across social standards, there's data that needs to be provided and risk that needs to be managed around your own employees. And there's also the health and safety of customers and end users of your products, which needs to be considered. And then there's also the health and safety elements across pollution and all of that environmental standards. So it's an area where I've had a fair amount of interaction with health and safety professionals or HSE professionals within clients that I've worked with when it comes to identifying where they may have gaps, for example, in their existing ESG processes and policy.
Great. Perhaps I see an additional question from Emmy in the very beginning. Who evaluates, checks whether the double materiality assessment has been conducted accordingly? Is there anyone who wants to give input on the specific question of Emmy?
So I see the qualifying question being, does it need to be audited by a third party? You do need to provide information about the double materiality process, the stakeholders you've engaged, and what the output of that materiality assessment is in your disclosure against the ESRS standards, which would then have a limited assurance requirement. So it would need to be externally audited. If you're looking at getting your internal audit within an organization or get an external third party to just review the double materiality process assessment that you might be undergoing at the moment, for example, I don't know if there's a specific requirement, but Valentina might have more information on that.
Yeah, I think we mentioned before that internally the double material assessment, the checks, the validity depends on the structure of the company. Usually it's in the hands of the ESG managers, the ESG directors. But externally, yes, I think the external auditors will be the ones validating the overall process based on the standards.
Yeah.
And I can see in that final question, probably don't have much time to answer it, but
yeah,
that's what I'm very happy to answer offline if required. Yeah, there's a lot of things you need to consider, and I think any system that you're investing in, you shouldn't just focus on the ESG reporting part. You need a consistent baseline of enterprise data and data across your value chain on your ESG performance. Some of that will go into your annual disclosure, but you'll also have a set of requirements that will drive business applications. So how are you reducing emissions? How are you managing health and safety? What kind of workforce engagement do you need to do? So there's a broader set of requirements that you should consider, not just the package that helps you with this immediate ESG reporting problem, I think, is my initial kind of thoughts on the matter.
All right, I see indeed time flies. It's indeed already the end of the original time slot. Perhaps to close off with question for the three of you, whoever wants to answer it. If there's one piece of advice that you would like to give the people who are still in the session of today around the topic of ESG reporting, is there one specific element you want to highlight or give sort of a final tip from your side?
Perhaps I can just start. Avoid the ticking the box exercise, because it's absolutely not what disclosure is about. And don't be afraid to really review your methodologies on a yearly basis if you think that your business context is changing and evolving. And I'll stop here.
Yeah. Perhaps Velina or Jonathan from your side?
From me, I think I'll just say think holistically. And going back to my very first slide, and I appreciate it's not very sustainable in terms of how I say it, but try to achieve as many things as possible with one solution, and look for flexible solutions.
Great.
And mine would be, you obviously don't want it to be at too high a cost and too burdensome, but do pay special attention to that double materiality assessment, or materiality assessment, take it seriously, because really it should help you concentrate your efforts and resources on what really matters when it comes to managing sustainability within your business and reporting on it. So I think that's if you don't get that first step right, then the rest, you'll end up with substance over form. Sorry, yeah, or whatever the Velina had mentioned.
All right. Thanks so much, everyone, for joining today's session. It was our last webinar of the year, so also thank you for engaging in the previous sessions. So a lot of familiar names joining today. And also thank you, Valentina, Jonathan, and Velina for your input and presenting. Yeah, wish you all a great day ahead, or a wonderful evening. Happy holidays as well. And then we will for sure see each other in 2024. But thanks everyone for joining again.
Thank you everyone
Thank you.
for joining.
Thanks.
Cheers.